Welcome to video tutorial on chapter 9, the incremental value analysis, and how spotting relevant information is tough and incremental value analysis is the answer. So the way we do incremental values, we do two things. We focus on value, think incremental. Focusing on value comes down to you identify the decision maker, decision goal, available options. So decision maker, in this case, you and your partner deciding whether you should do the business or not. Then what is it that you value? What is it that you want? Your goal. Of course, our primary goal here is long-term happiness, right? You're doing a side business in line with your DNA. Now that's difficult to measure, but you also want to generate some cash flows. Right? Ideally, you want to maximize the cash flow that the side business will generate, and if that is positive, and then you not only get long-term happiness, you also get some cash flow. The third part of focusing on value is what options are available. Well, you could reject this idea and then remain in status quo, which is just you do what others are doing, that you do your major, get a job in line with your major, or you do the business, right? Then we are going to choose this as the benchmark, thinking incremental, and we say compared to rejecting and doing whatever else others are doing, if you do the business, how much more cash flow would you get? So first we think incremental benefit of doing the business. So the downside, if you look at the incremental cost, is if you do the business, you have to come up with $20,000. If you come to our financing situation here in chapter 8, in our case we are putting $20,000 of our own money, right? So when you come here, you see that, so that's one of the cost. You got to remember, cost is what moves you away from your goal of cash flow. So you got to put $20,000 of your own money, and then you see what you get in return is the incremental benefit by doing this business. Compared to rejecting it, by doing it incrementally, you will generate these cash flows. It says chapter 6, D88 and E88. So when you come to chapter 6, you look at D88, and that is this number, that from your first product you get so much, second product you get so much. When you add these two, and that's what you have here, and this is for the second year, adding from the primary product and the secondary products, and then you reach the steady state. So that is your incremental cash flows, your benefit. But then we ask, well, is there anything else that's going to bring you cash flow? So one thing you realize is, well, what happens? Why are we doing this only for 5 years? Just because we predicted cash flows for 5 years? Well, what happens at the end? Normally entrepreneurs, they start a business, they get it to work, get it to a steady state, then they sell it. Now later in chapter 12 we will try to estimate the value of your business. At this point, the most conservative thing is, well, at the end of 5 years you shut down the business, so then you sell your assets, and then you should be able to get so much money at the end, right? So this, if you see, that's the 20% of your asset values. We see the asset would have depreciated. So if you go to chapter 6 B90, this is the asset you have, 47,000 and 0. We say after 5 years you can sell it for 20% of that is the 9,400 that you have. Then the other one is the working capital. Remember, this is what you were holding on at the end of each year, and that is coming from chapter 6 B89 and C89. So this is that working capital, right? We wanted to have at the beginning of each year. But if you're closing the business, then that money is going to be released, and that is your 37,300 here. So you just go and find the chapter 6B 89, C 89, and you put it there. Okay, then we come to other costs. In addition to the 20,000, your need was 138, so the rest you borrowed. So now you have to pay interest on that. So this, if you see, if I program it, this is equal to, come to chapter 8, you borrowed this at 10%, plus you borrowed 18,200 at 20%, plus you borrowed 69,267 at 30%, and that's your interest cost, and every year that's your cost, and that's another cost of doing this. Then you have your opportunity cost of capital, and now the $20,000 that you pulled out also, and you are foregoing at least you require 5% interest. So 5% of 20,000 is 1,000, and you have that number going through. Then your opportunity cost of time. You say, well, by doing the business, you are tying up your time, and are you foregoing any income? Now this is where, if you do it as a side business, you are not foregoing any income. We have put 0. But if somebody is going to do this full time, right, then this can be a pretty high number. For example, if somebody is going to make $50,000, $100,000, if you are foregoing that, then you will see this number will become negative, right? But in this case, similarly, opportunity cost of resources is, are you tying up any of your resources, and could you have, like your apartment or car, and could you have made some money if you didn't tie up? But again, your vehicle or your apartment, you're likely to be using it to make money, so you're not foregoing anything. So that finally, here are your incremental benefits, here are your incremental costs. So this is 279,343, and so the meaning of this is, by doing this business, and you are making 279,343 more than status quo. So that is compared to just doing what others are doing. By starting your business, you're going to make so much more. So in addition to long-term happiness, you're going to make so much more money over the 5 years. If you say, if it's roughly 300,000, and if you divide by 5, it's 60,000. Divide by the 2, each of you are getting an additional 30,000 in addition to long-term happiness. So seems like a good deal. Okay, I hope this helps.